As more solar PV is deployed, wholesale prices at the time when solar yield is highest fall. Take a look at the infamous duck curve in GB for the average day-ahead hourly market over the summer months, compared to the yield of a typical solar array in London. Prices drop in the middle of the day when the sun is producing the most energy. This is because the supply and demand economics change. More solar means lower prices. When we compare the capture prices across Europe in the sunny months, we see some interesting trends. We've done this by modeling a 60 megawatt peak solar farm with single axis tracking in GB, Spain and Germany from April to September. Firstly, capture prices are decreasing across the board. In Spain, the capture prices are lowest in spring, not summer. This pattern is largely driven by air conditioning. In summer, higher AC pushes up electricity demand and prices. In spring, however, solar output remains strong while demand is lower, which often results in the lowest and sometimes even negative prices. In Germany and GB, the effect is less pronounced since air conditioning is far less common. As a result, instead of solar driving electricity prices, gas generation often continues to play a dominant role. So what might be the reasons for this fall? Well, firstly, renewable generation doesn't have a fuel cost, so the effective short-run marginal cost of solar and wind assets is close to zero. This is further exacerbated when considering subsidies and green certificates these assets earn, and means they will continue in many instances to generate at negative prices. With high energy costs, ambitious renewable targets and a push to net zero, the rate of renewable deployment, in particular solar PV, is substantial. About 66 gigawatts in GB and Europe was added in 2024, and a similar capacity is expected to be added by the end of 2025. As energy grids have a higher proportion of their generation stack that is prepared to generate at zero or negative prices, wholesale prices will continue to fall. This is evidenced by the falling value and capture prices in all three markets we analyzed. So what does this mean for the future? Negative prices and falling capture rates are no surprise to developers and energy markets. We're seeing that these trends are changing standard PPA terms with negative price clauses. This is also altering subsidy regimes, such as Germany's EEG subsidy, now knocking out after 1 hour of negative prices. In the GB market, since the AR4 CfD round, the subsidy knocks out for any period that the market reference price is negative. All of these contractual clauses and low underlying wholesale prices serve as a signal for both demand and flexibility. For example, if you co-locate a solar farm with batteries, they can time shift part of their generation to higher value periods. This is a core use case for GridCog that allows you to model the impact of flexibility in response to price signals. We also allow you to curtail your solar, which stops generating during periods of negative prices. Importantly, flexible generation assets such as batteries also provide the opportunity to earn further revenue from wholesale price arbitrage, ancillary, balancing and capacity markets, which will often generate higher returns than simply time-shifting PV generation. You can easily model solar revenues with up-to-date market data in GridCog. You can also evaluate battery co-location opportunities across regions to capitalize on low or negative prices. Reach out to find out more.